All right. Good evening and welcome to another educational and theory session for the day. This is your host Harsh on behalf of GTCFX. Once again, a warm welcome to those who are joining from YouTube and also those who have already joined from Zoom. Those who are watching us from YouTube, please feel free to type in any questions that you may have. I do have a habit of toggling in between, and we'll try and address the question right during the session. And so please feel free. And for for uh, for those in Zoom, we have Brother Matthew, Rohit Bhai, and Jaideep with us right now as we speak, and we expect others to tune in as the session progresses. And yes, Brother Matthew, as always, we'll try and analyze most instruments. That is, we'll quickly analyze euro, gold, uh, Nifty, WTI crude, and also Dow Jones. After the theory is done, today's theory is a bit tricky in continuation to what we have been doing, but we will try and do it in a very simple language. And I will also try and show at least one case study on the real-time charts. All right, so no need, sir. This is a usual practice. Since we started the second session, we always follow up the theory session with a practical one, so that both are done consecutively. And let's get started without wasting a moment here. And straight away, the risk disclaimer. Once again, thank you everyone for tuning in. Today's topic of discussion is going to be trading zones. Before we do that, let's go through the risk warning and disclaimer. Over the counter margin derivative contracts, including contracts for difference and spot foreign exchange, are complex instruments and come with a high risk of losing money rapidly due to leverage. You should consider whether you understand how these products work and whether you can afford to take the high risk of losing your money. It is highly recommended that you take independent professional advice before any kind of investing or trading in the above segments. This seminar serves an educational purpose and will not include any financial recommendation or advice whatsoever. Thank you. All right, sir. So let's get started with the basic theory. Last story which we discussed was about risk management and time frames. Earlier one was the Fibonacci. So after discussing four basic pillars, Japanese candlestick chart patterns, support resistance, trends and trend lines, Fibonacci ratios, and also touching base with the risk management session. Now let's touch base with trading zones. It is actually like that when we have the tools ready with us, like the Japanese candlestick patterns, trend lines, support resistance, Fibonacci are our major tools. This session, trading zones and risk management and sideways, these sessions actually help us sharpen the tools. So trading zones would act as a purpose of sharpening our tools, which we have discussed in the earlier sessions. All right. Now there are two trading zones, north and the south. So when we do a trend line, as simple as that, it could be an uptrend line or a downtrend line. Please remember the concept. North of the trend line is always buy zone, and south is always sell zone. Right here, that that is a rising market. So please remember, north is always buy zone and south is always sell zone. And this one is a dropping market. Again, North is buy zone and south is sell zone. Normally, when we are in a class, physical class, I, I, I do not write the zones here and take it from the audience. Most of them make a mistake of defining sell zone here and buy zone there. Why? Because the trend line is changed, uptrend to downtrend. But that is not the case, sir. North always remains north and south always remains south, irrespective of which trend line we are referring to, correct? And if you try and compare with the trading style that we follow, what we do in a rising market is buy the C and sell the D. So somewhere here, C is going to form all the points of the trend line. We are going to buy the C and sell the D. So since we are in the buy zone, the first activity we do is enter buying. So it makes a lot of sense, correct? The moment it enters the sell zone, like say the market did break the trend line, it enters the sell zone, then the downtrend begins possibly. So what we do is change our trading strategy. We sell the C and buy the D, correct? The strategy we discussed in the trading or trend lines. So sell the C and buy the D. So we are actually selling first. So please remember, this is the logic. Whenever your markets are in the buy zone, we need to always remember our first order will be buy, and it will be followed up with a sell. When we are in the sell zone, our first order will be the sell, and it will be followed with the buy zone. It is always it's so logical. Over here, this is the dropping market, correct? So what do we normally do in a dropping market? Sell the C and buy the D, correct? So again, the logic is confirmed, sell first and buy second. The moment you enter the buy zone, we start buying first and selling second, right? So again, quite logical. Since we have entered the buy zone, we are buying first and selling second. I hope this concept is clear. North is buy and south is sell, whichever trend line we are referring to. And whichever zone markets are lying, that will be our first trade. For example, let me also try and do some practicals. Yes, I'm trying to do the same. This is I mean, irrespective of which chart it is, we are only concerned about the chart language actually, not really concerned about the name of the instrument, but it is a euro chart. Now, if you look at the uh, zones here, that is what? This is the buy zone, and that is the sell zone, correct? So here we are, since the market is dropping, let me hide it for your convenience. We can also extend the trend line from a higher point. So whether you are watching the higher point or from this point, it's a dropping market. So ideally, what we are looking for is uh, something like this, correct? At at these points, we enter selling, and here we correct buying or taking profits. Again, we sell and take profits here. All right. Now, the importance of trend lines, it really gets very interesting when the trading zones come into play. Now, earlier, this particular trend line was serving as a resistance trend line. So let me also do the zones here, correct? And so no problems. Now, watch the zones are changing. Trend line breaks. So we have not discussed this case yet, okay? But what we need to understand is now market has changed the zones from sell zone. It has entered into the buy zone, right? So from here on, our trading style or trading strategy will flip from sell first to buy first. From this point onwards, what we are going to do is buy first and sell second. And that's why the logic also clears up. Whenever you are in the buy zone, you enter buying first, and whenever you are in the sell zone, or whenever market is in the sell zone, let's put it that way, we enter selling first and then buying. All right. So it clears up the logic as well. All right. Now, going back to the screens, going back to the theory. Now, this is just the definition of zones. Okay. Matthew, it's a different thing. Of course, resistance, it's not that resistance becomes support. It's a simple logic. I mean, why are we complexifying or making it complex? It's a simple thing. In a buy zone, we enter buying first and selling second, and in a sell zone, we enter selling and buying second. As simple as that. The point that you are trying to make is past resistance become future support and past support becoming future resistance. That is in a trend, in an uptrend or a downtrend. So trading becomes more interesting when we keep things simple. I mean, keeping doing it more complex doesn't really help. I hope that it's now simplified and understood. Now, the only thing is, till the time market is in the buy zone or sell zone, okay, please listen carefully, sir. Till the time market is in either a buy zone or a sell zone, things are very simple. We have to we have to do it buy the C and sell the C, D, or reverse, sell the C and buy the D. But the problem, or it's not the problem, but you have to be careful when the zones are changing, like what I've shown here. All right. Now, this market is transiting from buy to sell, right? So in this zone, we have to be a bit cautious, and before trading next, we have to understand when does the zone change? Does it change just by prices penetrating? No, it does not change by just prices penetrating a trend line. When a complete bearish body forms in the sell zone, then the market has entered the sell zone. Brother Matthew, is it clear? When complete bearish body, Rohit Bhai and Jaideep Bhai, complete bearish body enters the sell zone. So here, something like this must happen. If the wick is touching the trend line, it is okay. But the body, this bearish body should be completely in the sell zone. Okay, not wave, just candle. Just candle. Either a candlestick pattern or if you're watching a bar chart, it should be a bar. If you wait for a wave, it will take much time. So it's not a wave, it's a candle. We just have to wait for one bearish candle. Okay. All right. So the moment one bearish candle is out in the sell zone, we can confirmly say, we say with confirmation that market has now entered from buy zone to sell zone. Okay. All right. And when one bullish candle, in this case one bullish candle, so over here if I print something like this, one bullish candle, as the first bullish candle has entered the buy zone, so the market has broken the trend line. See why we are discussing this. Let me explain the logic, sir. Many traders, they enter into a trade by this candle. Please look at the chart, sir. This is a bullish candle. So many traders make a mistake of entering the buy side of the market on this candle. This is half in the buy zone and half in the sell zone. It is not completely in the buy zone. So when we try and execute here, thank you, Brother Matthew, Anthony, welcome. Half candle in the buy zone and half in the sell zone will not work, sir. We need to see complete candle out in the buy zone. Is that clear now? Wick touching the trend line is okay. Body should not touch the trend line. Okay. All right. Let's move on. Now, the logic that we want to make clear now from this point on is what exactly happens or what exactly can happen when the market is trading or transiting from one zone to another. For example, if the market is in a buy zone and it is traveling or changing into the sell zone, what are the possibilities that can happen? All right. So there are three possibilities from when the market is traveling from a buy zone to sell zone, and then again three cases when the market is traveling from sell zone to buy zone. All right. So let's discuss all six of them. Believe it or not, I would not be able to show all cases because they don't produce all the time, especially case one. It 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 doesn't produce all the time, but I will show case three on the chart, both sides, from buy zone to sell zone and sell zone to buy zone, which is exactly where we picked up on 13th of January. So you can correlate or you can relate what exactly happens when the zones change and what exactly happens when they mean business. They do not mean business all the time. They mean business only in case 3. All right. So just please understand in a very light, keeping a very light mindset, because this case will not appear immediately to you. It will take time to unfold itself. So let's understand the logic first. The first case is market is in an uptrend. It breaks the trend line. It creates a new channel and it stays in an uptrend. I repeat, sir, market is in an uptrend, breaks the trend line, new channel is created and stays in an uptrend. So look at here, look at this chart, please. Not chart actually, the, the printed chart. Uptrend, okay, trend line break. When I say trend line break, now we all know one bearish candle must have entered into the sell zone. When the trend line breaks, every one of us needs to understand one thing. We have to stop buying. Here we were buying at C, selling at D, buying at C, selling at D. The moment it enters the sell zone, we stop buying first. We don't sell, we just stop buying because the market has entered the sell zone. We need to respect that. Okay? When can we sell then? This is a good question, right? Many traders make a mistake of selling right here. The moment it enters the sell zone and a body is out. Not the correct way to trade, sir. Why? Because this is our AB boundary now. This is our AB boundary. So where do we sell actually? We sell at a C. So we need to wait at a C. Let the market rally. Let it produce a C. Mostly it will hit the backside of the trend line. It will hit the Fibonacci ratio of this AB boundary and stuff like that. And by all means, we can sell this point because it's a potential C. We are anticipating markets to decline from here towards potential D. Nothing wrong at all. We are absolutely technically correct. Our stop loss will go up there. Okay. But then markets are markets and markets are always right. And if it doesn't drop, if it reverses from in between and prints a new high, right at this point, it is telling us a story that, okay, Brother Matthew, I'm really sorry. I broke the trend line. I came into the sell zone. I offered a sell entry point, but actually it was a mistake that I came into the sell zone. I'm wanting to go up from here. So please correct yourself. So what are we supposed to do? Yes, sir. Sell at a point. Most of the time it will hit the backside. If it doesn't hit the backside, you should be at a Fibonacci ratio at least. But then now the market has reached here. So the we are running into losses, right? This much is the loss. And the market is now telling us a story that it's not wanting to go down because that was a mistake. Maybe some fundamental announcement came or some trigger and markets broke the trend line. But that's not the case. It doesn't want to go down. So we've got to correct ourselves. Yeah. Yes, right, Jaideep bhai. Sell near resistance, buy near the support or a Fibonacci, whatever you understand, whichever is easy to understand. But here, now what we need to understand is we have to exit the sell position, take small loss, and then we have to enter buying this point. What the market has started to do from that point onwards is A, B, C, and D. Again A, B, C, and D. Again A, B, C, and that is a breakout. All right, and this is the channel which we were talking about starting at the beginning. So once again, let's revise, please. Market is an uptrend. It's an uptrend. All right. Breaks the trend line. Breaks the trend line. Okay. Ultimately, a new channel is created. Yes, sir. It is creating a new channel. Market stays in the uptrend. We finally end up buying here, and our stop loss will be there, and we are still in the buy mode. Okay. So case one, despite the fact markets entered into the sell zone, we ended up buying the markets. Okay. We ended up buying the markets. That's why I keep saying when we are trading, the only thing we need to have is more patience. Yeah, this is the indication, Brother Matthew. See, we entered sell here. The market made a new high after that. This is the indication that market is possibly coming back into the rising trend line. So we need to do this channel, and we need to find us. We need to exit the sell. We need to enter the buy. Is that clear, sir? I hope it is clear. The point we are trying to understand here is just because the trend line is broke doesn't mean we sell the market immediately. Even if we sell the market, at some point in time, we need to correct ourselves if market is forming a case one. That is, it is going to remain in the uptrend. All right. This thing actually happened in the dollar index just before making a high at 110. Let me try and find out quickly. Today's session will take some time, sir. Okay, I need to change. It may go 15, 20 minutes. Here, if you look at, if I did the trend line here, normally during the fourth wave of the Elliott, this was the trend line, it broke the trend line, it enters the sell zone, it also almost takes the support line. It might have just reached the outer trend line. Let's check. Okay, so this is the second case. It also broke the outer trend line just a bit, okay, into the sell zone. But then you see this channel making. This channel was carved. This channel was carved here. And that was the older trend line. And finally, it made a new high. It went up all the way towards 110. It's actually 110.20 with 8 cap provider, and otherwise it is 110. So this case doesn't really appear immediately at the pop of an eye. You have to find out, you have to search. Normally it appears at wave 4, at the fourth wave of a market, because fourth waves are tricky. Either they are forming triangles or they are forming. We will discuss. I think Elliott wave is the next session. So we will discuss fourth wave, and you'll understand what we are discussing at that point in time. But case one are very tricky. Case two is very simple in the sense uh, inner trend line or the immediate trend line, it breaks. Remember, market is in an uptrend. Let me help visualize. This is the market. Okay, and so from this point, it is rallying. It breaks the trend line. It travels to the outer trend line or the intermediate trend line and resumes towards a new high. So what changed? Nothing actually changed. The market was in an uptrend. It is in an uptrend. It's a capital A here, capital B, capital C, and now it is going towards capital D, correct? But in between, what happened? It gave us an opportunity to sell and then take some profits and then turn buy again. So immediate trend line break, you can sell temporary. So here you can sell and you can keep your stop loss there and take profits here at the bounce of the outer trend line. Something, let me show if something like case 2 is happening right now. We need to go at the immediate market. Okay. Okay, you can see this particular trend line is gone, or maybe you can say we have a question. Where the second high is not higher than the first high, Matthew? You're talking about the theory or the chart? Yeah. Where the second high is not higher than the first high? Which one? Over here? Yeah, so that's what I'm saying. After it went into the bearish area, okay, let me explain again. After it went into the bearish area, so this is becoming our AB boundary, sir? Yes or no, Matthew? This becomes our AB boundary, Brother Matthew? Kindly confirm. Perfect. So if this is your AB, can we call this as a potential C at a potential Fibonacci ratio or near to the trend line? Yes? Perfect. So are we correct in selling this point and putting our stop loss there? Please confirm each step so that you are not confused anymore. Are we correct in selling this point, putting our stop loss here? Please confirm so that you are not missing any point here. Perfect. And you have a Fibonacci extension and the market is drawing towards the outer trend line or a Fibonacci extension or a Fibonacci support. And here you can we book our profits here? Will we get some profits by selling here and buying here? So that is what I was saying. We book profits here and then we turn buy. Does it make sense now? Okay, I think we are good now, right? Okay. So case 2, market breaks the immediate trend line. It moves towards the outer trend line or the intermediate trend line. Intermediate trend line is already bullish. We buy the case and let it run on the north side again. This is a classic example which I was trying to show on the chart here. Maybe the immediate trend line is broke. Market is slightly hovering around. It may drop towards the support trend line here. It may also take some Fibonacci support here. All right, somewhere close to 1.1250. Did we give a Euro USD buy range at 1.1250 if I remember last Friday? If it drops to 1.1250, yes, brother Matthew, I think you were there last Friday. 1.1250, 1.1350, some kind of that range. This is a classic example of case 2. Yeah, all right, perfect. So please remember, we have done case 1, we have done case 2, we are still not selling, okay? And now case 3 is the case which we will sell aggressively, and that is called a head and shoulder reversal. It takes 5 steps to reverse. The first step is the trend line break. The second step is the support break. The third step is watch the left shoulder. Fourth step is let the right shoulder form. And fifth step, let the pattern form. So let me explain in 1 minute, a couple of minutes. This is a very important case to understand because here is where the money is made. And I'm then going to show you the chart, what exactly happened on 13th of January with the dollar index. So the first thing, trend line breaks. Second, support breaks. After the support breaks, you don't go and sell the market. You simply prepare to sell the market with this AB boundary, wait for the C to appear. Sometimes it hits the backside, sometimes it doesn't hit the backside. Most of the time it hits the backside, and then you get a pattern up there. That becomes your A, B. This is your classic C and extension D. All right, and one of the best examples that we've just seen practically, and we've actually captured it all, is the dollar index. two steps. Step number three, left shoulder. Step number four, right shoulder. Step number five, pattern. And that is gone. It's a classic case of head and shoulder reversal. Head, left shoulder, right shoulder, and then gone. All right. That is case three. And you see what happens. What generally happens after case three is something like this. Prices hardly come back to the right shoulder where we struck the market. All right. Okay, let's have a quick look at all the three cases from sell zone to buy zone now. Again, very simple. Case one, trend line breaks, market in a downtrend, trend line breaks, new channel is created, and market stays in a downtrend. So down, market is down, trend line breaks, new channel forms, and finally we will have to sell somewhere here, and the market drifts lower again, continues drifting lower again. Okay. Case number two, market breaks the trend line, drifts slowly. This is a very beautiful example, but it's not happening right now as clearly as it should be. It is happening in the dollar index though. It is reaching the outer trend line somewhere, and it gave a buy opportunity here after breaking the inner trend line. And now we will be preparing to sell somewhere close to where the markets are trading right now. Here's what is happening. This is where an intermediate trend line is passing. So not exactly reaching the intermediate trend line, but you can see this rally was almost equal to the rally that we just shown in the theory. All right. And we are also approaching a Fibonacci ratio. 23%. That is the 38.2%. But normally this in a faster market, you need to have a 23% Fibonacci ratio as well. That is where we would approach the market on the short side again. The story is not complete on the short side. There's one more leg, huge leg coming on the short side as well. All right, so that is case two, and case three is inverted head and shoulder. Please notice, brothers, here the market is inverted. Head is down, left shoulder and right shoulder combination. So that's a classic example of an inverted head and shoulder. Five-step reversal. Step number one, break of the trend line. Step number two, break of the resistance. Step number three, watch the left shoulder. Step number four, let the right shoulder form. And step number five, let the pattern form. And here's the classic example of an inverted head and shoulder. Brother Matthew, are you here with us? Because I really appreciate a lot when questions are being asked, because that means something is being seen keenly. Okay, now we are being joined by Mr. Kiran. Thank you, Mr. Kiran, for joining in. And here is the classic example of an inverted head and shoulder reversal. That is your A, B, C, D. Trend line breaks, resistance is out. So step number one and step number two. Step number three is here, left shoulder, right shoulder, and then what we've seen is a reversal. So here is our head, not our head, but the head of the market. And then you have a left shoulder, and then you have a right shoulder. And what happened after that is right in front of your screens here. This is exactly 13th of January. See, let me also try and correlate with what happened in the fundamental markets or the macro news. This was the first time when the tariff tariff was announced by the US president. It was the first time, the first news headlines after a Sunday. It was announced on Sunday, and beg your pardon, 13th of January was the low, but this right shoulder appeared on 3rd of February. All right, that was the first headline news of the beginning of the tariff wars. But look at the markets, how sensitive they are. They dropped fiercely. They hit the backside of the trend line, but they did not take the low out. What it meant was euro is heading for a reversal, and we have almost captured 1500 points after that. Still, the story is incomplete. There is one more wave left on the north side. So, all right. So that's a very powerful technique to trade a head and shoulder reversal, either on the upside or downside. We have done the practical implementation along with the discussions. Let's quickly view the chart analysis for the upcoming week, as suggested by our friend Matthew and others. Rohit Bhai and Jaideep Bhai would be waiting for the same. So, first things first, Euro USD. So, Euro is into the fourth wave, somewhere in the vicinity of 1.1250 and 1.1050 is the support coming in. It's almost at a support. I'm just waiting for it possibly could drop towards one more low, towards 1250 or so. But after that, we have an upside target. Let me bring it up. So that is wave one, wave two, all the way wave three. We take wave one, run it through wave three, bring it down to wave four. Let's give it an 1150 touch. Yes, sir. Let's look at that as well. Gold, February 3rd onwards. Let's look at that as well, because that's where the breakout also came in picture. So we have 1.17, we've got 1.2 as upside targets for euro. And let's flip the chart to gold. I think, Matthew, were you not there when we were discussing or in the live sessions for gold? Or I don't know exactly if you're there or not, but this was the time zone. It was not a head and shoulder at that point in time, but the head and shoulder was not seen in gold at that point in time. But if you see at the price action here, 3rd of February was a top. All right, I think somewhere here was gold. So it was not a head and shoulder reversal, brother Matthew. That it was a corrective wave forward. This was a sideways correction. This was a sideways correction when the event occurred, and it almost went on for a month. Bottom was formed on 28th of February, and from that point onwards, the rally started. This was the last wave, but the last wave again is extending. And let me evaluate the last wave extension for us now. There is one more wave potentially left for gold. Please let us pay attention what the price action is now telling us a story. The boundary in question is this one, wave 3. So we've got wave 1 extension within the extension, wave 2 within the extension, wave 3, wave 4. Now look at that wave 4 hovering around the 38.2% mark. There could be some sideways action like A, B, C, D, E, maybe a triangle or an ABC or a complex WXY, but it's already bottoming out. Now, the only thing which needs to be seen carefully, gold needs to be above 3168. If gold stays above 3168, that would be wave 4 bottom. Let's say it forms a bottom. I think 20 uh, 3270 is the bottom which is formed right now. It may print a new slight lower than that low. So you can keep a potential stop loss at around 3160 because that's wave 1, the termination point of wave 1. And keep a stop loss there. Buy as close to 3300 or as close to a low around 3260. Okay. Or you can split your trades. Brother Matthew, I think you are absolutely clear with the lot size, which you sent an email to me, zero point 0.05, and also when you are buying, don't buy 0.05 into 2 or 3 times. Your entire trade setup should be around 0.05 lot size. Potential stop loss goes around 3160, 3168, that high, and the upside target for gold, provided it remains above 3160, which is our stop loss. The upside targets for gold are as follows. Now, it is not necessary that this could be for current week. This week may be a bottom forming somewhere close to 3260. It could be a bottom forming, and then it may rally towards 35 plus and 3675. So that is the story for gold. I think specifically, Brother Matthew, you must have noted it. Rohit Bhai, you must have noted it as well. If there is any other instrument to be seen, Rohit Bhai, please let me know. Jaideep Bhai. Okay, thank you. Done. Jaideep Bhai, I hope it is done with you as well. If you want any other instrument, let me know, please, or we can bring the current session to a pause. Mr. Kiran, if you do have any other instrument practically to be analyzed, please feel free so. Thank you, Jaideep Bhai. Thank you, Rohit Bhai. Thank you, Mr. Kiran. Thank you, Brother Matthew. Thank you, Brother Anthony, as always. If you do have any other instruments, I'm still here. Thank you, Kiran. Let's bring today's session to a pause then. Thank you once again for your valuable time that you have spared. And we'll be back again tomorrow at 4 p.m. Eastern with the live sessions in Hindi. All right. Until that, please take care.